it's a multi-strategy asset allocation in a fragmented world. Lots of different styles of investing, lots of things going on right now. Before we start, why don't we do a brief introduction of each person, background and firm. So, Keith?
So, Keith Haydon, Man Group first. Man Group founded in the early 1780s, so roughly the same time as you guys made a decision to go it alone. Good call, I think. It's been through various forms, but is now essentially an active manager, almost very active. About $100 billion, north of $100 billion, mixture of long only and long short stuff. As to me, well, I've spent quite a lot of time investing in this sort of product, and quite honestly, a lot of the stuff that the hedge fund universe produces is really designed for the hedge fund managers, not for the investors. You can understand it, it's their businesses. But it's not easy to use, and if one of them produces a fantastic Sharpe ratio, but a return of 3%, it's pretty hard to figure out what to do with it. And so what I've spent most of the last 5 or 6 years doing at Man is trying to work collaboratively between the different hedge fund groups within Man and re-engineer some of those products to get closer to what it is that I think the clients ultimately need. So there's about 25% of Man's assets now which is in adapted form for that purpose, and I'm the Chief Investment Officer on that lot.
Sure.
Troy Gayeski, co-CIO and Senior Portfolio Manager at SkyBridge. Thank you all for coming to our conference on our 10-year anniversary. As most of you know, we're a high single-digit return-focused shop. We're just trying to figure out every year the best way we can generate a 6 to 10% return with as little risk to the downside as possible, which for part of this bull market's been somewhat boring, but years like last year, people appreciate what we do a little bit more. And our main focus today is on consumer credit, regional and community bank credit, and our biggest short exposures are over in corporate credit, primarily high yield and investment grade, where most of the bad behavior that's occurred this cycle has transpired.
Okay. John?
Sure. So, John Graham, I'm the Senior Managing Director of Credit at CPPIB, and I was told that some people might not be familiar with CPPIB, and I should give a very brief introduction to the organization. So for those who aren't familiar, CPPIB is a professional investment manager that manages the surplus of the Canada Pension Plan. The Canada Pension Plan is the mandatory payroll deduction pension plan in Canada that all working Canadians contribute to. As of December 31st, we had about $380 billion of assets under management. We're in a good position that we're still cash flow positive. We'll continue to be cash flow positive for a few years. So expect that number to double from contributions and investment returns over the next kind of 5 to 7 years. I think maybe 2 attributes of CPPIB that I'd like to highlight for the audience that I think is very relevant to this discussion. The first is our governance structure. Even though we are a Crown corporation, we have an investment-only mandate. Very simple mandate, maximize return without undue risk of loss. We have no mandate for regional economic development. We have no political interference in our investment activities. And because of that, we really have a geographically diverse portfolio. We have offices all over the world. I currently am in Hong Kong. We have over 100 people in Hong Kong. And we have 85% of our assets outside of Canada, and we actually will continue to push outside of Canada and grow our assets outside of Canada. The other, I think, key attribute is our certainty of capital. We're in a privileged position that our beneficiaries can't remove their capital. They can't take it out. And that gives us a lot of certainty, and it gives us the ability to be a very patient investor. So as we think about asset allocation, we think about allocation over a 25-year plus time horizon, and not over a quarter time horizon. So we can be pretty patient. We can play the long game in a lot of asset classes. Our portfolio today is a mix of private, public, across a whole bunch of asset classes. And just to calibrate from a risk equivalency, we're 85% equity, 15% fixed income.
That's a much longer time horizon than most of us on stage.
It is a privileged position.
My name's Josh Friedman. I'm the co-founder with my partner Mitch Schulis of Canyon Partners. We've been around about 30 years. We have around 250 employees and offices globally. We're an alternative investment manager that tends to focus on complex, process-oriented, value-driven situations, value and event-driven situations, generally in the debt universe. So we've been one of the largest distressed debt players globally for many years. We We also have a number of specialties within the firm that have evolved over the 30 years that we've been in business. So we focus on everything from structured distressed credit to corporate distressed credit to direct lending to other types of disciplines globally, largely in the US and Europe, although occasionally things in further afield places like in the Far East. We've started out with a simple hedge fund platform that was really a credit-driven distressed platform, and over the years we've evolved a number of platforms in other areas, including real estate and including structured ABS types of vehicles.
Yeah, in 2018, we started the year worried about wage inflation, 4 to 6 interest rate hikes, a growing economy and an expanding economy that was supposed to last into the 2020s. 2019, we're talking about possible rate cuts at the end of this year. Troy, what do you see?
Well, look, I mean, as we said, last year would be the year of peak cyclical growth for the U.S. We'd come in around 3% plus or minus. That's exactly what happened. We anticipated slower growth this year. When you look at every contributing factor to GDP, it'd be very hard to have the same amount of consumption growth this year as opposed to last, just because we have less job creation. We're on track for about 2.4 million jobs created versus 2.7. But we could have similar consumption, but it'll probably be slightly less. We're certainly going to have lower CapEx, not only because financial conditions tightened last year, but people forget, but half of the CapEx in the cycle for the U.S. has been tied to oil and energy, and obviously there was a big fall there. And trade is much more of a wild card. It was very good print in Q1. Time will tell. Our assumption was that it would be lower because all other reasons, the dollar's stronger and you have much weaker growth in Europe. And then when you look at inventory adjustments, we've been somewhat dangerously building inventory. But all that being said, we're looking somewhere, it's a wide range, 1.5 to 2.5. But the important point is we're going to comfortably avoid a recession this year. The consumer is just too strong for a recession to occur. Just about every metric you look at the consumer, whether it's debt to GDP, which has gone from about 100% to 76, you look at debt to income, which has gone from about 1.32 to 0.98, you look at financial obligation ratios, you look at the JOLTS report yesterday, the consumer is in exceptional shape. And so the question is, as we go into 2020 and we start getting policy risk emanating out of DC, is that really enough to cause CapEx to roll over and go negative, inventory to be liquidated, and more marginal fires start to be made than marginal hires, which have really dominated the last 2 years? So our point is the next 12 months, coast is clear. We're going to grow, certainly at a slower rate than last year. And the risk is certainly well below 50%, somewhere between 1 in 4 to 1 in 3, that we have a mild recession or a beginning of a bear market next year. And then in terms of the Fed, look, the Fed did just about everything right that the data told them. It really wasn't until late December that they had a handle on how bad the data looked in Europe and how much China was slowing down. Their communication policy was obviously botched. But basically what Powell and the team did is they pulled a Yellen, right? Which, as you guys remember in early 16, just not doing something is a lot easier than doing QE4 or coming out with some new extraordinary stimulus. So as we look forward, we think markets are a little aggressive in pricing in the next move to be a cut. We think it could go either way. And it's unwise to have too strong of views on the back end of the curve right now.
With those headwinds, Josh, how are you seeing the long and short credit investment cycle? Where are we there?
Well, I guess I don't necessarily disagree with your comment about near-term recession, but that doesn't mean that we're not going to have some extreme volatility in the markets. When things get priced to perfection and the market has poor structure, you can get really severe downturns. We saw that in December. I would say there are 3 things that I kind of think about as a framework for this. Number one is we have a really bad market structure today where financial intermediaries are no longer financial intermediaries with any principal exposure at all, so that all of the principal risk has been offloaded to people on the periphery of the capital markets, like us, buyers and sellers, and the others are really have reduced themselves to an agency role post '08. And yet so much money has gone into passive and into 40 Act structures that have a fundamental asset liability mismatch. They buy high yield bonds, yet they offer their investors daily liquidity. They can't sell on one-day liquidity. So when the market turns and they try to sell, the consequences are really steep price declines. We saw that in December. We saw that in the beginning of 18. We'll see it plenty more times because that structural infirmity is not getting corrected anytime soon. The second thing is, I think that it may not be recession that drives the market down, but it may be markets are psychological, and there are so many important global issues that have just been deferred and deferred and deferred, and the list gets longer and longer, and you can see what they do to the markets when just one of them has a little uncertainty, like trade this week with China. Whether it's Brexit, whether it's trade, whether it's growth in Europe, which is looking awfully weak, whether it's issues with respect to the presidency and impeachment or the Russia investigation. The list is very long. And when something happens, it affects people psychologically. And when people get affected psychologically, they put their hands in their pockets and they don't spend money. Whether consumers don't spend money or whether businesses don't spend money. And these have a real effect. And then markets react accordingly. And when you have the fragile market, that can create opportunity. And the third thing after those two, I would say, is that the central banks and the governing bodies across the world, particularly in the US and Europe, really don't have particularly strong tools to address this. They're trying, and we've seen the Fed, but when the Fed began raising rates, we saw how quickly the markets reacted. And in other parts of the world, there's certainly no ability to raise rates because they're already at zero. And with deficits where they are today, I don't see as much of a likelihood of blowing them out even further in order to do fiscal response. So fiscal and monetary responses can be pretty limited. So when I add that picture up and I look at the pricing of, say, high yield, or the pricing of investment grade, or the pricing of most, call it simple to buy securities, I tend to want to sell simplicity and buy complexity. Because complexity, at least you have event drivers, you have things that might happen nearer term, they have events that are happening. There are reasons why they require a more, my partner Mitch calls it a more artisanal approach, a more hands-on approach to realizing value, that are value-oriented. And I think we're in that kind of a market where that has to be the approach. And sometimes that means shorting some of those more run-of-the-mill things. I know we've gotten a lot of publicity for a short position we have on CMBX, particularly later vintages, because it trades tight as a drum, and the underwriting standards have dropped through the floor. And there are secular trends against big parts of the real estate market anyway, and we just think that'll be a good psychological bellwether, even when nothing happens to those particular securities. So that's kind of our framework for looking at the market and where we see the world right now.
John, you have a unique perspective of being in Hong Kong, and actually your mandate is to expand, like you said, beyond outside of Canada and look at EM. What do you see in terms of the credit markets in Hong Kong? Are you facing the same challenges that Josh sees in developed markets?
Sure. And maybe I'll also just explain a little bit of kind of our approach as an organization to emerging markets and why we're putting so much emphasis on it. And we just came out with our 2025 strategy, and one of the key tenets is to invest up to a third of the fund into emerging markets by 2025. And it's up to, it's a qualified number, so it's up to. And we
All
are
in on the Shanghai?
yeah. And we're actually currently at 20% of the fund in emerging markets. And I think one of the really important things is this is not because we see tremendous relative value in emerging markets. This is actually, back to my first comments about playing the long game, of looking at growth rates in China and India, looking at growth rates in Europe, thinking about where we need to develop a competency, where we need to develop relationships over the next 5, 10, 25 years. And to us, it's pretty clear that the EM is just going to be a bigger component of the global economy. And so we're spending a lot of time investing in almost the capabilities and the infrastructure in those regions. So on the credit side, I think, I'm in Hong Kong, and one thing I will emphasize, even though we are spending a lot of time thinking about EM, our portfolio is 90% DM and credit.
Yeah.
A lot of challenges investing in EM credit, and even within that, our portfolio is 2/3 in the US right now for credit. And within EM credit, there's pockets of opportunities around the globe. We have about half our EM in Asia, half in Latin America. And I think probably the one market that it's a good example is the renminbi market, the China onshore market. And I think the purist in me, and probably the purist in most people, would want to see an emerging market premium. If you really take a look at it, strip out the fact that I think the lowest rated bond is AA-, and really start looking through fundamentals in the market, there's no emerging market premium. The relative value probably isn't there today. But Josh and I were speaking earlier, one of our investment philosophies is get in there, learn the market, build out the capabilities. Because one thing about that market is when it cycles pretty hard.
Yeah.
And if you're not there, and you haven't spent the time up front, you can't take advantage of the pricing. So that's really a lot of our approach right now in EM, is just taking advantage of dislocations that happen around the globe.
I thought you had a great comment in the back. We were talking, can I quote your comment? From
I don't know.
We're talking about the trade business with China, and John was saying how a trade deal and compliance with some of the things the U.S. is asking for would be great in the long run for the Chinese credit markets and for growth in China. Because to me, you need a great credit market to have great growth. One of the reasons small businesses have grown to the extent they have is because of the whole public market nature of non-investment grade debt. Has given access to capital to huge growth companies everywhere. And it's hard to have access to debt capital as opposed to highly dilutive equity capital if you don't have rule of law and predictability. And that's been what's been completely missing in markets in general in the Far East. I mean, we all learned in our upbringing in the market. I'm a little older than you guys, but I remember Asia Pulp and Paper and all these people studying the debt, and somehow at the end of the day, the debt got nothing, and the same people still owned the company. This was what would happen in emerging markets.
Good old Indonesia,
Yeah, I mean, exactly. So I think that the idea of having the legs on the ground there now, which I know you have, I know we have an effort there as well, although quite a bit smaller than yours. This would really benefit if you get better rule of law, better transparency, better compliance, more meaningful debt documents. Then you can have a self-adjusting restructuring process that creates a lot of opportunity.
Better property rights.
Absolutely.
Keith, let's take a break from the fundamental side. Let's talk about man. You guys take a very quantitative and technical approach to investing. What are your models telling you right now?
Yeah, so there are bits of man that are discretionary, but I'm certainly more involved at the moment with the systematic stuff. And the positioning is interesting. It kind of aligns with what Troy was saying somewhat, I think, in that they're long, they're pretty long, they're long of bonds, they're long of equities, they're long of anything, which you could sort of think of as that meaning anything. But the reasoning is completely different. And by the way, saying that they're long is not terribly interesting, because by the time I get back to London, it may turn out they're not so much anymore. So one of the differences is that we don't really think in terms a lot of the time of forecasting return. So we've got three guys. I'm an outsider, not just because I've got the funny accent, but we tend not to think in terms of forecasting return. It's much easier for us systematically anyway, using computers, to forecast risk. And if you decide to forecast risk, which, by the way, whereas many of the things that we've tried to forecast in the world have become harder to forecast because of the competitions, risk actually continues to be pretty much the same phenomenon it has been for 100 years. If something is not risky today, the chances are it won't be so risky tomorrow either. I'm not saying that it won't be risky tomorrow, I'm just saying the odds are that way. And if you're playing odds in that way, what you want to do is to take as many positions as possible so that the law of large numbers breaks out in your favor. So the reason we're long is partly because stuff's going up, and we tend to trade with momentum. A lot of the signals are technical, that is to say they're driven by the prices of the securities rather than by the value of the securities. But we're also long because risk is low. I mean, volatility is amazingly low across pretty much all the asset classes in the world. I mean, ridiculously low. And what tends to happen is that the computers scale the risk every day, larger if risk is lower, smaller if risk is higher. It's quick, it adjusts very quickly. But at the same time, what it means is if you have low running risk conditions like these, you take a lot of risk, you take big positions. And the first sign usually of things going wrong is that volatility starts picking up, and then these things start selling fast. And I spent 15 miserable years, no, I enjoyed them actually, when I was a lot younger. I won't be getting those years back. As a discretionary macro trader. I don't recommend it. And not these days anyway. And the deal then was like, either you've got to be stubborner than everybody else, and by stubborn we mean seriously stubborn, or you've got to be quicker. Well, quicker hurts less, and we're that. That's what computers do well. So the first thing is it's risk-driven, not return-driven. The second thing is it's fast, and I guess get the sense that many of you, I mean, like John particularly, God Almighty.
I know,
I'm not
25
going to live
years.
that long,
Wow.
right? I mean,
Yeah, we'll be collecting Social Security then, man. Or at least I will. Yeah.
it's not very far away from me. The third thing is that there's a lot of this concern about what the underlying return rate is. You know, kind of these securities don't yield a lot. There's been a lot of bond repression around. There's too much money chasing too little yield. We tend not to make our money out of the underlying return from the security itself, but by trading it. So Josh said he'd like to be short simplicity and long complexity. We go like long and short of simplicity all the time. So it's a trading activity. It's the change of position which will drive our returns. And that forces us into, or keeps us safely, I might say, in the liquid market. So like for us, 1 month's liquidity is a long time. You know, we expect to have to, I used to make the joke that you could shut Man Group down in about a month. But that wasn't a very good joke, and I got told not to. Lara was right about that. And it's not true anymore, by the way, either. So we will be technical, quick, and vol-related, and we're trading a different universe. And the views that I might have about what are going on in the world, it's tempting to make a comment or two, and it's even easier to regret them afterwards. So I'll leave that to these guys.
Yeah.
Keith, just to respond on the long complexity. You know, what we've always specialized in is these things like bankruptcies and restructurings and arbitrage and things. But in a bull market, that's a great way to focus because the other stuff's not interesting. When the markets tank, we actually try to go long simplicity.
Yes.
Sometimes that's where the value is. You know, the first thing we did in December was we asked everybody, okay, make a list of a bunch of plain vanilla high yield bonds that have dropped 10 points that might actually be interesting now. Sometimes the people who are stuck selling, the mutual funds, they only can sell simplicity. It's the only thing that has a bid. So sometimes that's the most, they sell what they can, not what they should. So that focus changes, but I'd say at this point in the cycle, definitely, I think you're
So I'm
right.
looking forward, I'm hoping you're going to kind of stimulate the conversation in the direction of what exactly does happen around these inflection points and how the liquidity is going to play. But I'll tell you, that's your job. I'm going to shut up.
My job. Well, actually, I wanted to go back to Josh and talk about the fourth quarter.
The fourth quarter?
Of
Well,
2018.
you know, it was a good time to do a lot of things, but not enough traded quickly because there's a lot of cash on the sidelines. So the spike was quick.
Yeah.
You know, the sort of January down spike in 2016 was awesome. It lasted. It was quick, but it was deep enough and long enough that we bought on the order of $10 billion worth of paper over that 12-month period. Much harder to do during this last one because it was quick. So there were 5 or 6 different strategies for taking advantage of that. One was, okay, make a shopping list of things that were completely uninteresting a week ago, but now are all of a sudden interesting. You know, you execute what you can, but it's hard to put that much money to work that way. The second thing is you have the first month in 10 years where the high yield market's not open.
Yeah.
There might just be a few investment banks who are long bridges that they thought they were going to get rid of by printing deals. So, there were 2 or 3 of those deals where you could pick up bank debt from Wall Street firms that didn't want to have it on their balance sheet on December 31st, and you could buy it at 94, 93, or 92 and get together with a few of your friends, and there aren't that many people bidding. And that's a way to put literally a few $100 million to work. The third thing I'd say was take your regular shopping list of stressed and distressed things and maybe a little bit of it shakes loose. The next thing is go directly to the private equity world because there are deals that have to get done. And they may not actually print during that period, but you can get yourself in a position to get better covenants, better rate, et cetera. So there's sort of an inhaling and an exhaling process that we have in this business. If you look at, we bought a couple $1 billion in these sort of 5 or 6 categories. There were some stressed areas like oil services that were interesting. Most of that we've actually parted with already. Mm-hmm. So now we're sitting with 20 points lower of gross footings in our funds than we had a year ago, much lower. And now we're sitting here trying to assess what's going on this week. And will that create more opportunities, or will it just U-turn or not happen?
But back to your point on market structure, I mean, the main reason our largest short is in high yield and investment grade credit is because those markets have exploded in size. Obviously, you have $3 trillion of triple Bs now. You have, $2.5 trillion between levered loans and high yield. And it's estimated 25% of the high yield market has daily liquidity, right? So, if you look at where leverage levels have gone, for instance, at the lows this cycle is about 1.2 to 1 for net debt to EBITDA and S&P. Now it's up to 1.75. You look at how much covenants have deteriorated. 90% of the levered loan market is now covenant light. There are many good fundamental reasons to have shorts on in high yield, and now that spreads are super tight again, the risk reward looks great. But the technical aspect you highlight is also very important, because that's where you're going to get gapping price action, where people are seeking liquidity, and Josh is sitting there licking his lips, wanting to buy at 5 to 10 points down, and they're forced to do that. And in contrast, that's really the beauty, we think, of structured credit markets right now, is after the big 15-16 flush, what happened there is a tremendous amount of multi-strategy shops and kind of moonlighters saw big returns in 12, 13, 14. They hired guys, they levered up, and then, oh my goodness, there was a drawdown in 15, 16. And so you flushed out a lot of the kind of moonlighting capital. And now you have, a market structure where, we have about 55% in what we call structured credit, about 45 is in resi, 45 is in CMBS, mainly multifamily. Although we have a little conduit, and we think this 14, 15 vintages in particular look good. You're somewhere between a 6 to 10% loss-adjusted yield. CMBS is a little bit higher in that 8 to 12% range. And even CLO double Bs, which we don't love because they have the most price downside in the next correction. 9 to 9.5% loss-adjusted yield compared to 4% in high yield. Think about that spread, right? And like we were talking about before, the problem is it's hard to buy, right? Because nobody's selling. But if you own it, it's a great trade to have. And so between that, and then you look at what's happened to regional community banks, I think so few people understand how much deleveraging has occurred in the financial system, right? Whether you look at, you've gone from 20% ownership of the high yield bond market to less than 1 for prop desks at major dealers. Debt to equity for regional community banks has gone from 220 to 72.
Yeah.
Think about that degree of deleveraging. And the beauty is there's still, which Josh is involved in with some other managers we invest in, called the TRUP CDO market, where basically you own levered trust preferreds through capital structure, not through balance sheet. You have about a 6 to 8% cash on cash yield, 8 to 12% loss adjusted yield. They're long life, so they'll be around a while. And the fundamentals keep improving. So every time we look at the economy or look at the consumer, one thing we're pretty sure about, and this holds for banks as well, is before fundamentals start to deteriorate, they have to stop improving, right? And for the time being, consumer credit, for the most part, exceptions, subprime auto loans and credit card receivables to some extent, and regional community banks, those fundamentals keep improving. So if we can be long those and then short high yield and IG, generate about a 7% net loss adjusted yield, that gets us very close to our high single digit return target, with obviously much less downside if things start to go south.
Yeah, John, CPPIB has recently made some investments in CLO equity.
Yeah.
Wall Street Journal, right? A1,
yeah. Look, and I think this is actually, it's building a little bit on some of Josh's comments, and I think it's, we basically view CLO equity as through the cycle to be a decent asset class, and we develop partnerships with 2 managers to date that we think are really best-in-class managers. As far as the credit portfolio, it's 0.1% of our portfolio, and we see it as really developing those relationships and the framework so that if we do see market opportunities, we can invest in size and in scale. I think one of the things we struggle with, and just trying to think from a business perspective, is how do we stay in a market? How do we stay knowledgeable about a market? High yield's a great example. How do you make sure that you have your team tracking the 60 names that they like when the market's really tight? Last year we were the same. We came in and we bought in size, and we pretty much exited all the positions, but we always maintained some base level activity to keep the team in the market, keep them relevant in the market, and on top of the names.
And the one thing we say, for people that don't have 25-year time horizons, or like ours are more, how do we make money in the next 6, 12, 18 months? Because that's about as far in the future as we can look. We prefer double Bs because we look at it as, recession risk starts to pick up late 2020, early 21. And one thing we're pretty sure with double Bs is they're not going to crack unless we have, like a 2000 to 02 type recession. Whereas, in CLO equity, that stuff can turn off. And, a lot of people are going to find out when that happens. 2.5 years in, you suck out 2.5 years of coupon, shuts off, and then you're hoping for a recovery at some point. But that's interesting because the different time horizons and the different risk profiles,
Yeah.
Circling back to something Josh had spoken about earlier, both John and Josh had spoken about earlier about the challenges of investing in EM. What will it take to get you comfortable to really invest in markets where the rule of law just aren't developed yet, but there are opportunities?
Yeah, well, what will it take to get comfortable? I would actually say we are reasonably comfortable already. I mean, we are reasonably comfortable that there are opportunities, and we have spent the time to develop the relationships and develop the capabilities. If I just shared, what keeps me up at night, what gives me night terrors about investing in EM, I mean, I think fraud is still, fraud's everywhere. It's still an issue. Even with good auditors, even with quality of earnings, you still got to be pretty alert and really pick your partners pretty careful. And on the legal framework, I'd say it's getting better. In a lot of countries, it's getting a lot better. I mean, we were talking earlier, I mean, I would say that there's many European countries that are not creditor friendly.
Yeah.
And won't be creditor friendly for
Ever.
the next
Pretty much
for the
ever.
foreseeable future, and I think going probably the wrong way. But I think the momentum in some of the EM, India, they've really overhauled the system.
Brazil.
The courts in Shanghai and Beijing are actually very good. But I think the bottom line is in credit, you have willingness to pay and ability to pay. We take it for granted that people have a willingness to pay, and that's probably something you got to think about. Make sure you pick the right partners.
Yeah, we have a kind of it's interesting because our perspective, we have for example, we've been trading Chinese futures markets systematically. And as you might expect, many of the technical characteristics of those markets are quite attractive. They're very deep, very liquid, and they're very inefficient. But they do have a nasty habit of closing on you every now and then. And
At the wrong time, right?
yeah, and the great trick is that you should be able to go short, but if you can't go short because it's going down too much, that's not cool. And it reminds me a lot of the situation that obtained when I was trading years ago with emerging markets, where emerging markets were risky places. They shut down, they were structurally unsound. What you meant by emerging markets was you didn't know what the rules were. And there was an excess return associated with that. Now it feels like it's different. People look at emerging markets where the word emerging market doesn't really mean anything very much. It's one of these countries which isn't what you used to call a developed market. And the return quite often is not particularly exceptional. But it is occasionally. It's just that it changes very quickly as people get forced back into remembering it. So I think it's an unstable world, but it's not a different world in the sense that provided you're getting paid for those risks, and by the way, the thing that's bad about an emerging market risk when it goes wrong is it looks horrible. I mean, they used to close foreign exchange markets on this and say they're not convertible anymore. And you go like, what do you do about that? And that's no different really, I think, to these sorts of things. And provided the return is there, it's fine. Well, with the risk.
I mean, at the moment, rates are higher, spreads are higher, governance is better, and transparency of how the markets work is better in the US. That's a general statement, and it's not always true, but it's true more often than not, and certainly for us, we're more comfortable there. That doesn't mean that we haven't done things in India or in the Far East or in other markets. We have and we will and we do. But those markets are in a different state of evolution, and we'll see how it all shakes out. You need a higher level of certainty and higher compensation for taking risk. And sometimes, like if you look, even in Japan, where rates are literally zero, we participated in that Toshiba restructuring, which was born out of the Westinghouse subsidiary credit problems. But the best way to play was to participate in the rights offering for the equity 20% below the market, because much more liquid and you could see where the market was, how it was going to play, as opposed to buy debt securities. And it's not like the debt in the US is always transparent either. And we are in a market where we think of it as yield starved, and it is relative to our hurdles certainly for plain vanilla things, but it's still higher than the rest of the world. And then you get all that behavior that happens when you have institutions like all of ours trying to earn yields and pension funds and everything else, and there's not enough yield to go around, then you get all that really bad behavior that people have while they're fighting for yield. Creditor on creditor issues and very nasty fights with sponsors who are much, much more aggressive because they can be. We're talking about the lack of covenants in some of the deals that are brought to market. Well, by design, the lawyers pitch the PE firms and say, if you hire me, I'll get you a deal that has literally almost nothing, and you won't have a dividend test, you won't have a builder basket, you won't have anything. So in a market like this, it allows that to happen. But at least the rules are relatively clear, and you can assess those risks and make judgments. So that's why we've done much more in the U.S. and sort of Western Europe than we have in other markets.
And while we're talking about emerging markets, I know there's going to be a lot of focus on opportunity zones at the conference. And I love Cory Booker's phrase, how opportunity zones are the emerging markets of the United States, right? But so there's been a lot of focus on that, but there's other pilot programs at Freddie that I know Josh is aware of, whether it's the Freddie K program or the Freddie SBO program, which we focused on quite frequently these days, and we think is a tremendous opportunity in CMBS in particular. Right now you have about a 1.5 million workforce housing shortfall, which is designed to somewhere between 60 and 100% of the average median income of an area. And so basically what Freddie's done is they've structured a program for $1 to $7.5 million loans, so you can think 20 to 40 unit type properties, a lot of them garden. And managers, including some that'll be here, they take down the mezzanine slice of that capital structure with very good debt service coverage ratios. They're somewhere between 62 and 68% of the capital slice. And right now you have about a 10.5% loss adjusted yield, which again compares very favorably to BB CLOs at 9 to 9.5. And if you look at the stress test, in the history of Freddie K multifamily, they've only had 5 basis points of realized losses. So let's just multiply that by a factor of 10, because these are newer programs. So let's assume the next downturn is going to be 10 times the losses. So then you can multiply that by 8, and then these things still yield 2 to 2.5%, which is a tremendous return. So we look at that and say, hey, 10.5% loss adjusted yield under rational stress test scenarios. You have a significant downturn well beyond what we had in the crisis, and you still have a positive outcome. And the supply-demand dynamics of workforce housing are very favorable. You've had the best rent income growth. You've had the lowest, the biggest drop in occupancy rates. So we think there's a tremendous tailwind. And compared to CLOs, again, you probably have a fourth of the risk and probably about an eighth of the mark-to-market volatility. Yeah. So that's one of our favorite, sort of emerging market in the U.S. trades that also will probably get a tailwind from all the capital coming into opportunity zones, which should obviously cause those properties to appreciate in value.
Keith, there's been a lot of changes in the markets over the last 10 years. Financial regulatory reform, inflows of passive money. How has the market structure affected your investment programs?
Well, the move from active to passive has been going on forever, and it's gone a bit faster recently. I don't really blame them, really. It's making an excess return against a benchmark when you've got to cover fees and transaction costs. It's hard, and most people don't manage to do it. So I don't think there's any great life in that stuff. It hasn't affected us very much because we're at the, we've got, our long-only managers have got as much as 95% active risk, so it's barely an index player at all. But the biggest change for us has been that since the banks became so much less involved in making markets, the whole route of transaction, and of course we trade a lot, we turn over about $6 or $7 trillion a year, that getting that stuff done when the banks are no longer the central players, what's happened is the execution processes are fragmented. And it dawned on me as I was making my way here that this is the home of our technology. This is trying to choose the right route to market for each of the individual things. We use machine learning algorithms which basically look at what happens every time you fire a trade down to a particular route. And you break a single executional trade into lots of little pieces. You look to see how quickly it works and how well it works, and then send the rest of the trades down the most efficient path, but occasionally checking to see whether or not anything else has got more efficient. Now that is called multi-arm bandit technology. You've only got single-arm bandits in here, and you should learn. But it's very effective, and it's probably the most effective machine learning usage which we've come across. So for us, it's been an opportunity rather than, I think, a problem.
Got it. I think we have time for 1 or 2 questions from the audience, if any.
We were that exciting, huh? Articulated a lot of thoughtful questions.
It's always risky.
Well, I think of you heard of?
We heard some about the consumer, but that was about it. Yeah.
I think
Sorry,
the moderator
sorry.
needs to repeat
I, don't
that.
have my
Sean
I,
answered that one.
I didn't put my miracle ear in this morning. I don't know if anybody can get him a mic or if you want to stand up and approach the stage.
It's good.
Here he comes.
Going to walk up and shout.
You're a fine man. Mm-hmm. Yeah. Oh yeah, 100%. So it's actually interesting. You know, again, whenever you talk about data, we tend to talk about the mean and the median. But obviously, there's a distribution of outcomes. Just like every borrower is not terrible. And so by no means are we inferring that when unemployment goes from wherever it is, right now 3.6 to 6 in the next recession, there aren't going to be defaults. Of course there are going to be defaults. And the question is how much you're getting paid to take that risk. So you've already seen credit card receivable defaults go up. You've seen subprime auto loans defaults go up significantly. But if you look at the broader distribution, I mean, every metric you look at, from wage gains to financial obligation ratios to debt service, to Jolt's report, looks very positive. And it was actually interesting. Bloomberg did some very good analysis, and the main point of the report was income inequality. Right? That's a big problem, and hopefully opportunity zones can help solve that. But one of the things that came out of that research was that, talking about the lowest 5 deciles of the population. So going into the crisis, they had a total of $10 billion of savings. Now they have $100 billion. Right? That's 10 times the cushion, the shock absorption capability. So across all deciles of the population, you're in a much better shape than you were, certainly in 06, and arguably as good a shape as you've been till the early 90s. And we've had the highest savings rates since 91, 92 now for about 4 or 5 years. So not obviously speaking in somewhat generalities, there will be defaults, but for the most part, we see a very strong consumer that owns that backs the assets we own.
Yep. Well, I think we're out of time, but gentlemen, thank you very much.
Thank you.
Thank you.